All right, everybody. Thank you, all of those who came out for taking the time to come hang out at Stablecoin House with us and talk about how we build the future of money. And thank you to everybody who's tuning in on the live streams across YouTube, X, and LinkedIn as well to hear Ameya drop some amazing knowledge. Do you want to start with a brief intro and Flourish and things like that, and then we can kick in some talking points?
Absolutely. Hello, everyone. Kevin, I have to say thank you for having me here, and this is a delightfully laid-back setting. I love it. So Flourish Ventures, we're an early-stage venture fund with a purpose, and that purpose is financial health of individuals and small businesses. That's our mandate. And against that mandate, we invest in fintech companies, seed, Series A, sometimes Series B, across the globe. We have a portfolio of about 80 companies, $800 million of assets under management. We do US, Latin America, India, Southeast Asia. I lead our work in Africa and Middle East, also do a bunch of global cross-border payment infrastructure work. And really, I said that it's a fund, but it's not. It's an evergreen investment vehicle. We have a single LP who's Pierre Omidyar, who's the individual who founded eBay. So we have a lot of tech, marketplace, payment DNA. And Pierre has different pots of money, and this pot of money is the tip of the spear. So we take disproportionate risk with this pot of capital to advance entire sectors forward, which means that we will invest in the first or second movers in frontier geographies, in difficult segments, where it doesn't really make sense as an objective capital allocator to invest capital. But we'll do it because we want those companies to be commercially successful, but maybe more importantly, we want that sector to move forward. And therefore, you have me sitting here investing in payment acquiring companies in Nigeria.
For full disclosure, Flourish is on the cap table for Borderless. And one of the reasons that we were really excited about partnering with you and the team is when I think about fintech in emerging markets, to me, Flourish is like the apex predator of making those sorts of investments. You guys have been investing for many, many, many years in fintechs, payments, and other infrastructure companies across Latin America, across Africa, across Southeast Asia, all regions which we now see as the hotbeds of stablecoin adoption and stablecoin activity. Yeah. So I'm curious to kind of understand from the perspective of where you sit and more importantly, the amount of time that you've been sitting in that perspective. What is driving the on-the-ground adoption of stables in these emerging markets?
Yeah, it's relatively simple. The biggest reason USD-based stablecoins are adopted in markets like Nigeria or markets in Southeast Asia, South Africa, and Latin America is that they provide access to dollars. The world does not have enough dollars for perfectly legitimate cross-border use cases. Folks want to receive their salaries in dollars. Folks want to make payments in dollars to their suppliers. Companies want to move treasury money in dollars. So let me give you some concrete examples. I'm going to use Nigeria as a use case because I'm very close to the market, and also it's one of those markets that is the perfect match of needs and supply for stablecoin. Markets with the biggest demand for stablecoins have two characteristics. They have a weak currency and they have dollar scarcity because they are import-heavy markets. So Nigeria is an import-heavy market. Despite being an oil-producing region, it imports all of its petroleum. And so it is in constant short supply of dollars. The state doesn't have enough dollars to satisfy the needs of all the importers. And so enter stablecoins. The biggest use case for stablecoins in Nigeria is to pay suppliers for stuff like petrol and so on. And the second biggest use case is storing value in a currency that doesn't depreciate structurally. So I'd say, in answer to your question, without going on a big monologue, the two biggest reasons for stablecoin adoption in these markets is storing value in a stable currency and getting access to dollars, which is not available from the traditional banking system.
Makes sense. I think one of the narratives that we hear a lot in the stablecoin world is the dollarization narrative, right? Stablecoins are the best access to dollars, whether it's corporates or individuals, people in emerging markets want stable currency. I think the antithesis that I've always had is that that's a very short-term value proposition for stables. And the reason that I think that way is if you extrapolate this out, controlling currency is one of the main forms of authority that a sovereign state has.
Yeah.
And if you play this out to its full extent, we're not going to see countries, especially those with tight capital controls, all of a sudden completely forego their own central bank issued currency to have every company, every citizen, and everybody in that region actually transacting in dollars through stablecoins. So I'm curious to kind of see where you think this may play out, and maybe it's Nigeria, maybe it's more capital aggressive countries like Turkey, India, other places. Yeah. The INR isn't disappearing in favor of USDC. How far can this go? Do they fight back? Do they force conversions? Kind of what happens when the nation states come in?
Yeah, I was just having this conversation actually with Rod here. This is a question I think about every day, Kevin. Because if you take away the regulatory, macroeconomic, and geopolitical constraints to stablecoin adoption, I think we'll see a world where within 5 to 10 years, stablecoins are the preferred rails for most payment mechanisms. But you have to constrain that growth with all of these boundary conditions. And so let me ask you a question before I answer yours. Sorry. But what's the goal here? What's the dream? Is stablecoins in your mind as a network of networks maybe that facilitates stablecoin orchestration? Do stablecoins become the preferred mode of exchange, but they're only in the background? Do they also then become a retail interface for payments? What is the dream?
I think from our perspective, the big value add for stablecoins is to build an interconnected financial system. And what I mean by that is we've historically had very fragmented money movement capabilities globally. And these fragments in a few different ways. One of the ways is obviously currencies. And I think nation states are highly incentivized to keep their currencies. That's why we haven't seen the entire world suddenly adopt the Bitcoin standard or something of that nature. But the other fragmentation has come from a rails perspective, right? So you have PIX in Brazil, you have SPEI in Mexico, ACH and Wire, SEPA, mobile money, all these different things. And I don't think that there's necessarily a nation state incentive to have a payment rail in much the same way there's a nation state incentive to control a currency. So I think where stablecoins start to become really, really interesting is as an interconnected rail that's able to not necessarily replace local real-time payment systems, because outside of the US, there's plenty of amazing real-time payment systems. PIX comes to mind, Instant SEPA comes to mind, things of that nature. But in the ability to have a real-time bridge that's able to cut across all of these different global payment systems. And I think once you can have that as a payment mechanism, does something like a stablecoin completely replace SEPA transfers and open banking in the EU? I don't think it needs to. But if stablecoins can connect that to an import-exporter in Nigeria, that's where the value to me is.
So in other words, stablecoins remain a tokenized way to exchange value globally, but they're in the back end. And maybe what they remove is those ancient SWIFT messages and the three banking intermediaries. So we're singing from the same songbook. So let's take aside dollarization of domestic economies, because I agree with you. We're not going there, right? So let's take that out. And if anyone in this room feels that that's an inappropriate exclusion, we should have a conversation. We should also take out the idea that stablecoins are going to intermediate local real-time payments, right? I don't see the value of stablecoins to orchestrate payments between European countries because SEPA exists. I don't see the value of stablecoins intermediating domestic payments in India because UPI exists. I do see the value for stablecoins to intermediate domestic payments in the US because it's done in ancient card rails. No offense, Kevin. But for most countries like India, I'm Indian, and my mom just goes and scans a QR code. It's free, it's instant, and it's on ACH banking rails. So there's no problem. Now, for cross-border transfers, we run into another problem, which is Forex and Forex reserves. And I think this is a really important question to which I don't have the solution, but I would love to brainstorm with you. So let me just play this out in the case of remittance transfers from the US to Nigeria, because it serves to illustrate the issue. Remitly, Nala, Lemfi, all of these retail remittance companies power remittances from US to Nigeria to the tune of $20 billion every year. It's a huge source of USD reserves for Nigeria. a lot of these payments are already done through stablecoin orchestration at the back end. The challenge is Nigeria and Nigerian government wants those dollars onshore because then they get recorded in the forex reserves of the central bank. They are available to importers to buy useful stuff like petroleum, and a Fitch and S&P looks at them and says, hey, you have forex reserves to cover 3 months imports, and I'm going to give you a triple B negative. If in the extreme case, all of those $20 billion turn into stable coins and they're off-ramped into Nigeria in Naira, i.e. no dollars actually show up onshore in the banking system in Nigeria, we have a huge problem because that's a $20 billion hole in the central bank balance sheet. And so this process is, by the way, this challenge also exists in the traditional TradFi cross-border work. It's called netting, where, to give you an example, sorry, I'm going deep into this, but this is very important. So let me give you an example to explain what netting is and why stablecoin transfers are considered to be netting. Let's say a Remitly wants to transfer a bulk USD transfer into Nigeria. At the same time, Airtel Nigeria wants to send a bunch of Nairas back to headquarters in the US. A company that's intermediating this transfer won't bring the dollars into Nigeria and take the Nigerias. They'll just net it out. In other words, they will move the money from Remitly, they'll move the dollars from Remitly HQ bank account to Airtel HQ, and they will move the Nairas from Airtel Nigeria into Remitly Nigeria for payouts. So no dollars actually show up on Nigeria. This is not allowed. This is illegal. The reason this is illegal is because no dollars show onshore. This is illegal in Nigeria. This is illegal in India. This is illegal in most Southeast Asian countries. You cannot net out dollar transfers because dollars don't show up onshore. The same thing happens when a stablecoin transfer is initiated and accepted, because no dollars show up onshore. It's a dollar-to-dollar transfer in a US bank account and a Naira-to-Naira transfer in a Nigerian bank account. So the central bank does not like this. And I don't have a solution to this, but I think this is what stablecoin payments and cross-border will run into with many dollar-hungry countries with a weak currency.
Do you think there's a world in which the central banks become issuers and redeemers of USD-based stablecoins so that they can force the liquidation of stablecoins into dollars, actually represents dollars in country, and actually the central bank becomes the market maker?
This is the question we're exploring with the Central Bank of Nigeria at the moment. I think this touches on so many geopolitical and macroeconomic angles that I can't think through all of them. I just don't have the capacity to think how the central bank governor would react to becoming a minter of a dollar-based stablecoin. But this is a hot question that we are working with different governments and regulators to address. Maybe the other option, Kevin, is, look, at the end of the day, no dollar ever leaves the Fed, right? So do stable coins then become a denominator of dollar reserves that are counted as the forex reserve of the country? It's possible. But it'll require, what I'm trying to say is that it'll require a fundamental reorientation of the central bank balance sheet, the macroeconomic policies of the country, and it touches on so many different political factions that it's not a question of technology, it's not a question of customer demand. I think there's a lot of headroom to grow with customer demand, but it will plateau at a point. The asymptote is the central bank, and we're going to get there pretty soon. It's also, can I just say, it's also interesting, I keep reading that, hey, central banks are regulating stablecoins, but only central banks in strong currency countries are regulating stablecoins. I mean, yeah, I would pass the Genius Act if all the stablecoins are pegged to my currency. Yeah, sure, yeah, makes sense. MICA, yeah, I mean, Europe doesn't need stablecoins, or it's URC stablecoins. I don't think you will see these kind of regulations, especially for cross-border forex in countries with weak currencies.
The netting point is interesting because we're starting to see that in a lot of other countries that have heavy FX taxes, right? So like take Brazil and what's happened recently with the IOF tax spike there. We're starting to see a lot of people on the stablecoin transactions. I think there's two schools of thought. There's one school of thought, and I'm certainly not an expert on the Brazil market. I would defer to people who are. But one school of thought is like, hey, if you're purchasing stablecoins are a digital asset, can this avoid the IOF tax as an investment vehicle? I think that may be more of a technical argument.
Yeah.
If we go with like the spirit of the transaction, going to a stablecoin is not an investment. Going to stablecoin is a remittance settlement, in which case it does still fall under the IOF tax regime. So now we're starting to see all of a sudden companies who are able to net the inflows and the outflows together and effectively not move funds as massive, massive advantages in these markets where they can say, okay, all of a sudden 200 basis points just got lobbed off the transaction costs here because we can just net your outflow against matching inflows. And what I think is interesting is when we started Borderless, at least, one of the core theses that we had was that liquidity is super fragmented. So the more providers and the more FIs can become part of the Borderless network, the deeper that liquidity becomes in the same place. Yeah. And now actually what we're starting to see is not only is it about the depth of the liquidity that it's available, but it's about transaction matching. And if across the network we have 5 or 6 different FIs that are providing liquidity in Brazil and we see all the inflows and the outflows, we can almost run kind of like an order book on top of all of those things. And the order book's not there to set a market price. The order book is just there to get maximum possible netting achieved. Yeah. And of course, if the IOF tax now kind of reverses and it goes back to a few dozen basis points versus a couple hundred basis points, that goes away. But that was an interesting thing that we had never thought of. So I wasn't aware that netting is illegal in Nigeria versus now like the most used payment mechanism to avoid IOF tax in Brazil.
I think this is the prime question. I really think in global cross-border, netting is the prime question. It is not the prime question when you're looking at it from 30,000 feet, but for practitioners and operators, it's the prime question. I think we're thinking of the same company in Latin America that benefits from the IOF tax and netting. I mean, to be clear, netting was called, I think Wise was one of the first ones to actually match an order book with precision. They called it internalization. And so if you see Wise's take rates, you will not see the take rate trend downwards with increasing volumes. They're always 70 to 80 bips. And the reason it's 70 to 80 bips always because they are able to auto match. But then they work in mostly in G7 countries. And so what I'm trying to say is that I think there are many corridors, Kevin, where you can net out flows and that just makes it efficient. There are many corridors where you cannot net out because the government wants to see those dollars onshore. And I think for emerging markets, that's one of the biggest things that we need to solve. I was probably going to go into too much detail, but yeah, I think
I think that's actually the big key point on stablecoin-based payments, is in my mind, stablecoin-based payments aren't a technology problem at all.
Yeah.
They're actually an operational issue. They're a macro government policy issue. This is not something that a magic new token solves. This is not something that a magic new blockchain solves. This is not something that's solved by actual technology. We can move we can move tokens that represent money across decentralized networks in fractions of a second anywhere in the world that exists today, that has existed for some time now, that doesn't magically solve the payments problems. It's how you get into the operational details like the netting. It's how you get into how does the central bank recognize the dollars in their reserves? Yeah. It's when you get into these issues, this is what we need to tackle. And for me, one of the huge frustrations of being in this space is that everybody, or at least a lot of people, tackle this from a technology standpoint. Yes. And to me, those are people who are, potentially phenomenal engineers, but who have never worked in payments or banking or financial services or anything like that. And even at the basic levels, a lot of people are just focused on, do we know that the value transferred, and not how did these things reconcile? What were the compliance programs around it? What were the regulatory programs around it? It's so much more complicated that when I see the news articles of like, oh, stable coins are going to completely disintermediate 95% of the payment stack. Yeah. It's like, that is the immediate indicator that someone's never worked in payments before. Yeah. I don't know. I'm curious from your perspective, and then maybe we open it up for more questions from people in the house, because I think that'll be a more fun discussion. How much of the stack do you think does in fact get disintermediated and compressed, and how much of it changes for sure, but is more of a lateral shift versus a disintermediation?
Yeah. Let me just riff on something you said and then answer your question. We've discussed this, Kevin, and I think all operators in the field know this, but the biggest benefit of stablecoin-based cross-border transfers is to remove the pre-funding requirements. Yes. But let me put some numbers to this so it's concrete. I serve on the board of a company called Lendable. We are a wholesale capital provider to fintechs in emerging markets. We have $300 million of assets under management. And we lend to several payout companies that facilitate remittance payouts in emerging markets. So these are companies like TerraPay, Toons, Niem. We actually finance the working capital. So stablecoins are cannibalistic to that business line, but it's not a big business. But these companies need anywhere between 3 to 5 days of working capital. From Lendable, we would provide that working capital at 13 to 14% dollars. And usually these companies earn their revenues in dollars, so they don't really need a hedging product, but that would add on top of this. And so 14% for 3 to 5 days, you're looking at 10 to 15 bips. And that of 40 to 80 bips gross margins of these companies is a very significant cost. And so if you can move out those 10 to 15 bips from the P&L of these companies, the business changes entirely. You break even 3 years faster, and it's just a very different business. And that's what stablecoins do. So these companies are gravitating to stablecoins not because of some smart contract or because it's because they don't need to hold pre-funds in 7 countries that is costing them real money. And so all of this to say is that I agree with your point that it's a bunch of like nitty-gritty operational stuff that stablecoins solve. I believe that I'm not smart enough to think what will happen 5 years down the line. That's just like false precision for me. But I think I can tell you what I'm excited about. I'm excited about a lot of very old traditional remittance shifting to stablecoins. What am I talking about? I'm talking about RIA, Western Union, MoneyGram. We're leading around in a company that does payouts for RIA, Western Union, MoneyGram in Sierra Leone, Guinea, and Liberia. It's huge business. I'll give you some comparison. Toons and Niem do about $10 to $15 billion annually. Visa does $13 trillion. MoneyGram, RIA, Western Union each do $100 to $200 billion annually. This is huge business. We often miss this because we live in developed countries mostly, and so we don't see the RIA shop every corner, but it's there, right? So I'm thinking of $200 to $300 billion of remittance from these old guard players moving on chain over the next 2 to 3 years. That's huge already. I'm thinking that a new breed of companies needs to come up to solve the KYC, AML, CFT compliance issues that we will have on chain. We're leading around in a company that's trying to graph this out for cross-border payments. And finally, I am excited about the marriage between stablecoins, blockchain wallets, and agentic commerce. I think it's a match made in heaven. We're investing in a company that's tokenizing Amazon inventory and allowing agents to buy products through a pre-funded stablecoin wallet. And so I think these are the things that excite me, and hopefully we see some movement there. But we will hit that central bank asymptote. We'll see what happens there.
Very cool. Thanks, Ameya. Maybe opening it up from questions from people here. Does anybody have anything for Ameya or for me?
Yeah, and I'd love to hear from people what they think the goal is here.
Yep.
Where do you feel crypto and stablecoin end in consumer adoption?
Do you want to ask questions to the room?
Yeah, I do. Sorry, I should have used the mic. I'm here in learning mode, guys. I consider myself to be a TradFi guy, trying to learn what's happening on chain. And so I'm curious with operators and practitioners in the room, like, what do you see as your optimal state of crypto or stablecoin adoption 3 to 5 years down the line? What would you like to see as the dream state? You can take that question any way you want.
I have someone I want to put on the spot for this one. Do you have any thoughts?
I don't have a good. Yeah, we just talked about this. I had another question for you guys actually. So, yeah, exactly. Yeah, I don't really have a good answer to the end state question. Maybe I can think about it a little bit more. But I wanted to ask you guys maybe what corridors you're seeing a lot of growth on the stablecoin side. I don't know. I know in particular Flourish is investing in a lot of really interesting corridors.
Yeah, maybe I can answer with just what I'm seeing, and then I'll pass the mic on to you, Kevin. I am seeing a lot of action in Nigeria, South Africa, and US. That's where a lot of the stablecoin flows are happening, and they're happening in 4 or 5 big cross-border flows, Rod. So one of them is remittance, obviously. The second one is trade. So all of these remittance companies match the local currency with importers. The third is salary payments, and the fourth is marketplace acquiring and settlement. So I'm talking about a dlocal acquiring for Airbnb in South Africa and then settling that payment to Airbnb headquarters, or one of our portfolio companies acquiring for TikTok and settling those payments to TikTok, different creators across the world. So I think these big 4 flows from those 2 markets and Kenya catching up is where I see a lot of adoption in my area of experience.
From a kind of country geographic perspective, we started with Latin America as a company and then have been now pushing on Africa. And I think for us, the 3 biggest countries in particular are Brazil, Colombia, and South Africa are the 3 biggest countries where we see flow. And from places that we're kind of working on supporting that we don't support yet today, I think Philippines is definitely the #1 demanded thing that we get right now. I think for us, Q4 is going to be very Southeast Asia and South Asia focused. And then that gives us the coverage across LATAM, Africa, and Southeast Asia as kind of the 3 traditionally defined emerging markets. But definitely Brazil, Colombia, South Africa right now. Does anybody else have questions?
Actually, I have a question. So just with regards to liquidity and stablecoins in general, how do you see interoperability between not just your kind of standard wires in, say, ZAR or NGN, but you also have essentially mobile money you have in those regions, especially in Africa. In a lot of countries, obviously people don't use banks to send funds, right? We're talking about whatever when you put a pin in the phone and it does essentially wonderful things, like when you send funds through the phone, or if you have other barter elements in an economy, how do you see that interface with stablecoins? Because a lot of people in those places, they don't really have a bank in general, so they're classically unbanked. How do you see stablecoins kind of coming into play and liquidity in between those very odd pairs where you don't have your local currency, but you have like something like M-Pesa, or you have other mobile credits? Like, do you see anyone actually filling that problem and potentially putting wallets into that? I keep forgetting what it's called. There is a special SSD or something along these lines where you put, where you have a button phone. Yeah, exactly. So do you see anyone actually solving that problem? Because obviously in a lot of these markets, you'll need to create liquidity and create pairs in between stablecoins and these things in order to efficiently tap into what people actually use day to day. So that's also quite interesting to discuss, I think.
I think those are 2 questions in one. One aspect of the question you asked is, what are the pipes that connect a mobile money wallet, for example, M-Pesa in Kenya, to the banking system? And that is done by a bunch of what we call distributors, like mobile money operators, or some of the companies that I mentioned earlier, Thunes, Niem, etc. They connect the value that's stored in the mobile money wallet to the banking system, but the value is still stored in the local currency. That was the first point. That, I think, has been solved over the last decade. The second more important question is, what is the depth of liquidity in these obscure pairs, like USDC to Kenyan shillings? What's the depth of liquidity here? What's the slippage if you bring in $3 million a day? And I think the biggest change I have seen as I've observed this sector from 2017 onwards is that the depth of liquidity has grown to a point where end-to-end, that stablecoin sandwich is now cheaper than a fiat transaction. That was not the case in January 2022, because the cost to off-ramp this USDC into shillings was so high because there was not enough liquidity that it just wasn't viable. So I think it achieved parity early 2024, and now it's cheaper, I would say.
Yeah, I think from my perspective, I don't think stablecoins really change the game in local payments, and I hope I'm horribly proved wrong by this over time. But I think when you have people that are using M-Pesa and other things like that, I don't think we're going to anytime in the next couple of years retrain an entire consumer behavior to somehow use, I don't know, MetaMask or non-custodial wallets in some sort of a stablecoin or something like that. I think what's key, and it's kind of back to our interoperability thesis, is then making those funds that are held in that wallet, for lack of a better word, interoperable with stablecoins so they can then be used in cross-border remittances. And we actually have a couple FIs in the Borderless network that create liquidity between like Airtel credits and USDC as an example. So the liquidity is very thin, to be very, very blunt, on some of those markets, but we're starting to see market makers start to get into that. And I think you can either believe in one of two outcomes, and those two outcomes are either that stablecoin liquidity, the way it exists today, is the peak of what we will ever have, and in which case stablecoin-based cross-border remittances will become a niche in high volatile countries and small emerging markets. Or you can believe that over the next 5 to 10 years, stablecoin liquidity is going to 10 to 100x. And that's going to massively compress the margins. It's going to increase the amount of kind of usability that exists and those things like that. That's the thesis that we choose to ascribe to. And if that's true, then all of a sudden this really thin liquidity that exists between things like Airtel credits and USDC is all of a sudden going to become commercially viable as a bridge for someone to use some sort of an M-Pesa transaction locally and then send that money wherever they want in the world for just a few basis points.
Can I make an additional point? I agree with you, Kevin, 100%. And I think one of the conversations you and I had when we were doing diligence on Borderless was, I was telling you, I don't see a Borderless in the fiat world, right? I don't see it. I see bilateral agreements in Thun, SNIEM, etc. I just don't see a Borderless. Where is this orchestrated in the fiat world? And I think you said something which is very pertinent, which is, well, in the fiat world, the network is constrained by the requirement for pre-funding. So it's a financial boundary condition, which doesn't exist in the stablecoin world. So I do believe that we will reach a world where someone like Borderless or an orchestrator would aggregate this liquidity and it will be seamless and the depth of liquidity will grow because you don't require that exact pre-funding requirements, limiting the number of nodes in the graph. I'll make one other point, which I would be happy to debate, which is I don't think crypto should have a mass market retail interface. I don't see it. I don't think that an average Nigerian should have to interact with a stable coin. I don't see the point. Just the same way they don't interact with a Swift message. I need to see my dollars. There should be somebody who guarantees a one-to-one redemption. If you hold USDC, it's your problem. I want to see dollars in my bank account. I want to transfer that immediately. I don't want to know anything about Circle's S1. I don't care. And that's how I think the world should progress. And I don't know if you agree with that, Kevin. Or
I'm curious if anybody in the room is building a retail interface for crypto. Mass market retail interface.
High frequency traders, sure, but
Well, yeah. No one? Or people are too shy to say that they are? No one wants to debate you today.
There's people doing it today. Like there are people using, like Turkey is a good example. Like Turkey has a pretty good USDT, or like Argentina with Tron and USDT. Like there are people using stables for retail purposes. Now, that's a qualifier on what you said, mass market like retail, but like it's not, I mean, you're ceding a lot back to the traditional financial institutions, to the financial institutions by saying that there's 2-3 bits that will never go to consumers, that will always be in that friction between payment tokens or whatever, like the mobile payment tokens, whatever it is, to your stablecoin, if you don't get consumers on the stablecoins. Mm-hmm. And in some places, 2-3 bips is real money. I mean, like America, whatever, we just kind of suck it up, but like, there's two parts. One is, it's not usually 2 to 3 bips, right? Like when you're off-ramping tokens to stables, it's probably closer to 25 bips, right? So 25 bips is real money in Nigeria. Like it's not toy money out there.
25 bips is a huge amount of money in Nigeria. It's an entire business model that I'd be willing to seed fund. But no, let's debate this. But in that world you're describing, I'm very happy to just learn and think through this. Consumers have access to stablecoin stores and they use them as their store of value. So for example, this individual in Turkey would have stablecoin store in a stablecoin wallet and would use that stablecoin to pay for a haircut in Turkey. See, this then we get to the dollarization of the entire lira economy. And I think we run up against that wall. And so, these are the things that I think about when I'm taking a shower.
Yeah, no, I mean, it's a tough question because at the end of the day, you brought up currency controls, but currency controls are, I mean, China has the most aggressive currency controls of anywhere in the entire world, and even they have a huge black market for U.S. dollars there. So it is. I mean, it's interesting to see will you really be able to stop people if you can do this securely and very, very, very cheap, right? Would you just completely remove all the bips from the ecosystem, and it's just whatever the network fees are on something like Solana? I don't know.
I know. I agree with you. I think that the dream of instant and free global payments, if we hold that as the free body diagram of this thing, that is achieved only when the end is also a stable coin and it's not an off ramp, right?
Right.
Then I just transfer to Kevin, it's USDC or whatever, and you use it. And the transfer is again USDC. It's not on ramped into anything else. It's cool. I just don't think we get there with one. Then there will be one global currency. It will be a dollar hegemony or some global basket of currencies. I don't know, but it's just too difficult to imagine getting there. And I will make one more point. I think.
Is that to say that you don't think that there'll be other stables that really gain traction? The Euro C and these other guys are out there.
No, I don't see it. So, for example, I don't see the point of a Naira stable. I don't see the point of a ZAR stable. Why would anyone want to hold a ZAR stable? They'll hold the ZAR.
Isn't it by definition a ZAR unstable?
Yeah, which precisely the point, the end currency has to be stable or has to be the global reserve currency. That's when it's meaningful. What I'm paying, so Circle's $1.7 billion is coming out of somewhere, right? It's not free. For holding a USDC, I'm contributing to that P&L. How much is it worth now? It's $250 a share? I don't know. I should have just invested in Circle listing, something like that. 7x. But the point I'm making.
You have the live stream mic is still on. So.
Hello. Anyway, the point I'm making is that I'm getting access to a US Treasury tokenized through Circle, and I'm paying Circle for that. I don't think I would do that for a South African stable. I also think that China. Sorry.
Just hold this one.
I also think that, to your point, I think on the geopolitics, I think the geopolitical vector is another very important vector. And I think China is very well prepared. I think what they'll do is they can't prevent people from holding USD. But I'm telling you that this Coinbase Stripe thing that's happening right now is not going to happen for Chinese merchants accepting payments on Payoneer. I guarantee this. I'm willing to bet any amount of money on this. I think what will happen is that they will promote the HKD, the Hong Kong dollar, which is a pegged currency, and there'll be an HKD stable, and eventually there'll be a tokenized offshore yuan. But it's not going to be a dollar stable. Okay.
Cool. Thank you for taking the time. Thank you, everybody, for good questions. For those in the live stream, we will be back in an hour with Tomer from Stellar, who will be talking about payments from the perspective of a large OG payments-focused layer one. So, see you guys soon.
Thank you, Jen.
That's fun.
We also have some cold cuts and bread and stuff for lunch if anybody's hungry. There's water in the back.
Perfect.
In the U.S., Visa and MasterCard, with all the banks, have complete control. $172 billion last year in merchant processing fees. And the banks ate that and they would even give loyalty points on credit and debit because they were making it back on.